Construction represents 10% of global GDP, $12 trillion in terms of total spend. But construction tech is barely 0.1% of the total VC funding, which to me seemed like an unsustainable anomaly. People talk of stealth startups. We were truly a stealth VC in our first year, operating without a website. We are in the wait for 2 IPOs this year and 2 more IPOs hopefully in 2026. How much we choose to exit from those IPOs, we'll wait and watch. I'm being guarded in how much detail I reveal, but it's up to the viewers and for you to figure out what I might be saying. For one of the components of the investment, by the time we actually wired it, it was already worth 10 times of the amount we wired. In 2018, a lot of folks saying, hey, B2B commerce, there's nothing to be done in India. It's quite fascinating. Things have changed tremendously since then, and quite a few B2B unicorns have happened. A few IPOs as well have happened, about to happen. You don't need to be right all the time. You just need to hang around. If you just survive long enough, that's how you get to participate in the bigger wins.
Today, we get to speak to Shubhankar Bhattacharya. Shub is an ex-founder who built an online jewellery and diamond business for the Indian market. He then went on to join Kae Capital, one of the pioneering VC funds in India, where he made some incredible investments, including Zetwerk, HealthKart, and 1MG. Those companies are worth well over $5 billion today. Shub then left to start his own VC fund, Foundamental, which is exclusively focused on construction tech, which represents just 0.1% of all VC funding. It's a fantastic episode. Let's get stuck in. But just before we do, let me introduce this week's sponsor of the OpenVC Podcast, Intercom.com. Intercom help founders by making your customer service 24/7. Through their use of innovative AI, you can answer 50% of your customer needs instantly. Intercom is offering 1 year free if you use the code OpenVC, all in caps, at the checkout using the link in the description below. And let's get back to the episode. Shub, thank you so much for coming on to the season 1 of the OpenVC podcast. It's an absolute pleasure to have you on. Thank you for coming along.
First things first, Harrison, thank you so much for having me over. It's an absolute pleasure to be taking time out and thank you for reaching out. I look forward to an engaging conversation.
To start, I really want to go back in time to when you started having entrepreneurial thoughts. I know that your dad was a business tycoon who ran the Indian business of a global industrial company. Was it him that was sort of mentoring you a little bit to become a mini-me and giving you some business lessons?
That would be very poetic in so many ways. And I wish I could come up with some sort of very theatrical version of this story. I think the real world version of that is unfortunately much more mundane, if you will. So not to say I didn't derive benefits from my father's, what he accomplished. And I think most importantly, it instilled a sense of working hard, trying to strive for excellence, be it in academics or trying to always be the first in class, be the best in whatever I aim to do. And I think my life, especially my early life, took a more traditional route, especially traditional from the point of view of, think of someone in the Indian education system. The way we think of it is, hey, we go through our exams, a whole host of them, for those of you who might not be familiar, and it's a bit of a rat race, I must admit. So, and you're always up there trying to get up to the top 0.1%, 0.5%, etc. And that you need to get there in order to get a decent shot at the colleges and the institutions that you want to get into. And my father definitely played an influence there as well. But I think to get to the point of actually being a founder and starting up my company, I think it was a bit more of stumbling through various lessons that life throws at you, including going to a regular job and realizing that you're not quite cut out to do this for the next few decades, and realizing, hey, there's, ambition plays its own role and you want to be your own boss. And, now when I look back, I feel like we did so many mistakes when I started up along with my co-founders. So many mistakes to the point where if I were pitching to myself, I'd probably not give myself more than a few minutes. But it's fun how that's how things often turn out.
I mean, okay, so let's unpack that a little bit. You felt a little bit dissatisfied by the corporate rat race. You thought you could achieve maybe a bit more, and you actually did take that leap of faith and start your own diamond and jewelry brand.
Yeah, that my first venture, which is Yaksh, that was online e-commerce store for diamonds and precious jewelry. So the idea was that as India incomes rise, more people go into the middle class, more people switch to e-commerce as the preferred way of transacting. A lot of them will also value a more value-based transaction model to select engagement rings, precious jewelry, and things of that sort. It was hard going, I must admit. We were around for about a year and a half. Ironically, never managed to raise any money, which is something I really I see the funny side of it today. But it was really hard to pitch to investors, pitch to angels, and keep getting no after no again and again. We did actually manage to do some business, so of that I'm quite proud. And at that time, I think the general verdict across all the people we met, both from the industry, investors, was that, hey, people aren't going to be willing to spend big ticket transaction sizes to buy diamonds, engagement rings, and the like online. And obviously, unfortunately, Yaksh died a death. I just succeeded in running it to the ground. The truly fascinating thing is if you fast forward to about a decade, the online e-commerce space for diamonds and precious jewelry in India has already seen two unicorns. If I reflect on that phase of my journey a little bit, sometimes you don't need to be right all the time. You just need to hang around, perhaps. And that's the difference. If you just survive long enough, that's how you get to participate in the bigger wins, I suppose. And maybe we'll touch upon this on how it turned out into us starting up Foundamental as well, because it forms a pattern. At least in my mind, the pattern connects somehow in what our thinking is with regard to what Foundamental represents.
All the thesis is correct. It's just the timing hasn't aligned for you.
Mm-hmm.
E-commerce, India, high intent to purchase, high value
Yes.
items. Can you tell us a bit more about jumping from the venture into Kae Capital? Was the fund already well known? And what enticed you away from being a founder into
Yes.
being more of an investor?
So let me pick up the last question first. I must admit, I had no intentions of getting into venture. It was very much an accidental detour. I think the idea at that point was very much to just maybe join a startup, work in a startup, preferably at an early stage. I was talking to a few other firms. And then through a mutual friend, I got connected to the folks at Kae Capital. And, I remember even the first couple of discussions I had, I even told them, hey, I'm not an investor. I don't consider myself an investor. So actually, I'm not sure if this conversation is going anywhere, but nevertheless, I've been told I should speak with you guys. So let's see where this goes. And then I was told that they're specifically looking for a failed entrepreneur. And in a very peculiar way, and I guess that's how life is sometimes, it endeared them to me. Kae's reputation, it's an undeniable truth. It was one of the pioneers in India for the seed investing model. And I think that for that reason, the brand and the franchise has gone very far. And I think for that, even Kae Capital's founder and my ex-boss, Sasha, he needs to be credited for that. In some ways, he's one of the forerunners of the seed investing model in India.
So you didn't even want to be a VC. They happened to be looking for someone that could empathize with founders that had been through the wars, that wasn't
Yes.
sitting on a super yacht sipping their pina colada.
Yes.
But you didn't just hit the ground running. You absolutely exceeded all expectations with some of your portfolio investments whilst there. Zetwerk has over a $3 billion valuation.
Yes.
HealthKart just raised a huge funding round at a 500 million valuation, and
Mm-hmm.
1MG
Mm-hmm.
has had a unicorn status for years. So you're
Yes.
sitting on north of $5 billion worth
Mm-hmm.
maybe of enterprise value created during a 4-year time stint at Kai Capital. What were you doing so well?
I mean, often with these things, I must admit, it's about being at the right place, right time, which, as it sounds, also involves a tremendous amount of luck. I think with a lot of these opportunities, as well as stuff that has worked well for us at Fundamental, luck did play a part. I'm not saying that luck is the only determinant of what happens, but it would also not have happened without luck. So let me not
Okay.
deny being the beneficiary of
So
luck.
successful and humble. Got it.
I appreciate that. I mean, look, the other way of saying it is if you have had luck not go your way a few times in life or at work, that's when you realize, when good luck comes along, how much of a needle mover it becomes. And for that reason, I'm very grateful. So the reason I actually mentioned this is there's two truly memorable deals, or two deals that are truly extraordinary in how they came about, and obviously the financial outcome following them in my career, at least thus far. In Zetwerk's case in particular, what I think I'm particularly proud about as well is this happened in early 2018. So this was at a time when B2B commerce was pretty much a non-existent theme in India. So you usually look at B2B commerce as a theme which could not yield large outcomes at all in India. People far more articulate than me have coined the expression narrative violations. We at Foundamental like to call these kinds of anomalies vertical singularities, as to how rare they are and how you need to go against the grain of popular, let's say, VC speak, or what the narrative says, or what the consensus is. And I remember in 2018, a lot of folks saying, hey, B2B commerce, there's nothing to be done there in India. It's quite fascinating. Things have changed tremendously since then, and quite a few B2B unicorns have happened. A few IPOs as well have happened, about to happen, etc. And so that's where I'm actually very, very proud about Zetwerk, because it was one of those deals where it happened in spite of all that negativity and has gone as far as it has, and I'm sure it'll go much further. And it's one of the forerunners of this, let's say, new wave of B2B commerce firms in India.
Did you have to fight for it at the investment committee? Did it?
Yes. I mean, I wish I could go into all of the details. It was definitely not a consensus deal, and in a different set of circumstances, it might not have even been done by us. So it did need quite a bit of pushing and prodding, a little bit of luck, and thankfully that saw the deal through.
So you're willing to put your neck on the line for Zetwerk. But for a young VC out there that currently thinks, I want to make this contrarian bet, but I know my principal isn't too convinced. What kind of tools and techniques do you think are worth deploying at that point to try and help be a bit more persuasive?
My personal opinion here is that in recent years, most VC professionals, unfortunately, don't think of themselves as investors. They think of themselves as brokers or quasi-investment bankers. What do I mean by that? When you invest, you basically are prepared. Your default position is to hold or maybe invest more for the next 5 to 10 years, right? And you know what the value of the investment is, and you're prepared to hold your ground regardless or what others are saying about it. Mm-hmm. Your understanding of the value or the potential of the investment does not change depending on who comes in the next round, or whether there will even be a next round. Now, versus what I refer to as the broker or the quasi-investment banker mindset is, in that sort of mindset, you're doing an investment based on the assumption or understanding that you already think a next round will happen with so-and-so fund, based on some conversations you've had, or your friend works there, or someone else has told you that this is what they're looking for. Or in the truly horrible case, and I know that's not what you intended, a deal like this will make your case strong for the next line of promotion. Which, I mean, it is, unfortunately the reality of the industry today, but it leads to a lot of short-term thinking, a lot of transactional style behavior on why deals are done, why certain deals are pushed, etc. The reason I went down this rabbit hole was just to answer this question of tips and tricks. If there are young / not so young VC professionals listening to this wondering how you get ahead, look, either approach is fine. It depends on what you're in the profession for. If you're in it with the transactional mindset, that's also fine. But then don't use the deal to justify your actions. Use your own motivation to justify your actions would be my suggestion, because then basically you're in it for other reasons. Assuming you are an investor, I think it needs a bit of conviction, and hopefully you derive that conviction from a great deal of groundwork you've done, quite a bit of research or analysis you put in, and there is a reason that you get that conviction, even though there's a lot of pressure or contradicting feedback that you're getting either from within the firm or from other firms or from the wider market at that time. So it needs a bit of conviction and standing your ground, which is not easy.
I couldn't agree with you more. There's a lot of short-termism. I think that's going to get amplified with companies staying private for longer, because investors want that on paper markup rather than real value created.
Mm-hmm.
Um, so coming back to the conviction then, can you remember certain data points or reasons why you were convinced Zetwerk was going to be the exception to the rule?
I was relying on hard data on the founders. The founders, we done extensive reference checks, and they came with a very clear source of unfair advantage because one of the founders, he had ties to several manufacturing businesses because of other things his family had done. And he also was previously one of the co-founders of a firm called Off Business, which coincidentally also happens to be a unicorn in the industrials space in India. And we spoke to many different people around that sort of constellation to get a sense of what that unfair advantage truly entails and how much of a head start that gives them in getting this business off the ground. And at that point of time, I would say, look, I can call it a hypothesis, I can call it analysis. It was a hunch, it was an educated guess that at some point, if you just remove the friction of SaaS or software or any other kind of fees for admission and just allow businesses to get stuff done, to manufacture and serve needs of local businesses as well as businesses outside who may want to import from India, because that was also part of the thesis that more and more manufacturing for the world will shift to India. This could become tremendously valuable. And the question was, if this thesis plays out, if this is what the macroeconomic, the winds of change, if they're blowing in this direction, can I find a better team to do this opportunity? And I could find none. And I think that answer holds true even to this day. That is where a lot of my analysis focused on at the time. And I think the rest, I must admit, it was a punt, it was a guess, right? And that guess played out. Yeah, I was about to say, if I was trying to be intellectually honest with myself to see if I was any more rigorous on the market. I think no. I think I was quite rigorous on the team, if I'm being honest. Perhaps not as rigorous on the market size, other than a few hunches and I guess with the benefit of hindsight, well-placed guesses.
That is extremely interesting. Can you remember what stage you actually invested in? How much traction did they have at the time?
At the time, it was two guys with an idea. About $1 million, give or take, at a 4.5 million post.
Wow. That
Yes.
is a fantastic venture investment. Now that's well more than 100x. Okay.
Yeah.
So you're doing so well. You're doing so well at Kae Capital. You've got all this paper gains. You've got rocket ships that are taking off.
Mm-hmm.
But you decide to leave. Help us fill in the gaps. Why does this make sense? Not only do you leave, but you then go and co-found your own VC fund with two other partners.
Mm-hmm.
Right. Well, based on some of your track record and their track record, but you don't raise a small fund. Your first fund's $60 million. People want to
Yes.
give you money hand over fist. Talk us through that decision to leave. Just on a personal note, do you have to forgo any financial benefit that you would have had from all the investments that you made?
Yeah, I mean, look, again, it was a question of certain things that I discovered along the way. Actually, you know what? Before I start, I must admit, the 4 years that I spent at K were truly tremendous, right? As I mentioned, before I went in, I didn't even think I was an investor. I didn't want to be an investor. And I think that's the thing I'm most grateful to K for helping me find, I guess, my purpose and mission in life, right? Which I only discovered after joining K. So many thanks to K for that. And as a result, I realized like, hey, there's a few other things that are very important to me, which I was not even aware of. But now it really mattered in the sense. So there was this trip we had all done while I was at K in 2017 to China. And that's when I saw, so to keep in mind, this is pre-COVID up until 2019. I would say sometime between 2015 and 2019, China was the most impactful VC market out there. The most unicorns, the most funding, more than the US, just to put things into perspective. And when I visited, that seemed like a completely different world. And I was like, hey, how do I not necessarily get a piece of the China action, but how do I embed myself in an ecosystem or a network where I can be part of a global setup, where the limits of what I can achieve and what I can access are not limited to one country, right? So that was kind of like a process. The wheels were set in motion at that point of time. And that's something I thought I realized as time went on. That's becoming very, very important to me. That I didn't want to be limited by one geography. And
Okay.
I think I also realized the what really mattered and what appealed to me a lot was being able to learn from one place or one market or one model and applying those learnings in different settings, in different markets, across different models. And I think that started this uh, chain of events where I thought, hey, I need to find the next thing to do in life, whatever that means, right? Started speaking with a whole bunch of people, and one thing led to another, and I ended up getting connected to two guys, as you mentioned, who ended up being my co-founders. All three of us were at a similar point in our journeys, looking to start something, and one of us actually had the idea to start a construction tech focused fund investing globally. I must admit, my initial reaction to that was, eh, I love the idea of a unified global fund, even sector focused, but construction tech, I thought, is this really, the sector to back? I remember at that time going and seeking opinions or feedback from a few people. And some people even reacted by saying, what is construction tech? So that's how esoteric the whole concept was. There were alarm bells going off in my mind saying, hey, is this going to be a good idea? Am I going to regret this? And then I also asked myself, hey, could this be an example of something where it seems like a terrible idea today, but if we just stay in the game for a decade or so, but eventually it'll become an obvious thing which will take off, right? And I guess that's where maybe a bit more rationality and analytical thinking came in. And I mean, I don't want to bore our viewers with stuff, but if you look at it, construction represents 10% of the global GDP. I think about $12 trillion in terms of total spend, but it's barely 0.1%. Construction tech is barely 0.1% of the total VC funding. So contrast 10% of the real world economy with just 0.1% of VC funding, which to me seemed like an unsustainable anomaly. And I felt it has to revert, maybe not to 10%, but it has to achieve some sort of parity with other sectors. Think your fintech, your logistics, and many other travel tech, etc. Many other kinds of industries that are seeing funding. The thought process was, if we give ourselves, say, 10 years or 20 years, etc., if at some point during that, even if it goes from 0.1% to, say, 2 or 3%, it'll be a tremendous outcome for all of us. The industry itself is growing, and even as part of a growing pie, you have expanded 20, 30 times in percentage terms, and in absolute terms, it's even larger. And we were like, all we need to do is just have a few good companies from around the world, and we'll do very well for ourselves. So that was kind of the high level thesis. So in a very bizarre way, the decision, at least for me, at a personal level, the rational and analytical side took over for me. And it was not a pure snap judgment sort of a thing. Fundraising, again, I would say for the first fund, it was also, again, I have to say, a right place, right time sort of a situation. So luck did play a role in the first fund because, I mean, if we are being truthful to ourselves, we were all very early in our journey as investors, and we had not been proper fund managers by ourselves before. I mean, even Zetwerk, by the way, was a non-entity at that point. I mean, nobody outside of a few folks in K knew about it very well. So I think we definitely got lucky there, I must admit, but I'm glad that luck went my way again.
So, for those that don't know, Fundamental, you're based on the thesis that construction tech is the need of the time. There's a huge labor shortage of over 1 million workers in
Mm-hmm.
Europe. The demand for housing is only increasing. There are these non-cyclical macro trends that are only moving in your favor. It's very underinvested. You want it to be an early mover into that space.
Mm-hmm.
How are you able to bring LPs along with you on that journey? Because are LPs a bit more like investors? They're a bit more like sheep. They want to invest in what's known, B2B SaaS in Silicon Valley. How are you getting them excited about construction tech?
So there, I would say what has worked for us so far, it may change over time. Over time, what has happened is most of our LPs that we have today, these are folks that are either corporates or family offices who are in the construction industry. So in other words, they're either construction corporates themselves or families where the primary source of their wealth has been construction. The cool thing about that is, in some ways, it took the pressure off us having to be construction veterans in a weird way. What they value more is a very professional investor approach, a very analytical investor first approach rather than a construction first approach. So that's the distinction I'm calling out here. Being investors first rather than construction operators first, and who design a fund in a way where they strategically get more insight and more benefits and more access. So that's sort of our product or our value proposition to our LPs. Will it change over time? It might. I guess we'll see. So we are also growing and hopefully leveling up as a firm. And we'll also have to respond to what the market and what future prospective LPs want from us.
That makes a lot of sense, and LPs must be loving it because you're on your third fund, but there's
So
a
far, so
team of
good.
three
Yeah.
of you, and you do something a bit counterproductive, which is you go for this global approach. Each partner has a certain region, so you cover North America, the India Pacific, and also Europe.
Mhm.
How can three partners cover such a large global remit?
I think one thing that helps us to a certain degree, I think it's still a lot of ground to cover, is we limit ourselves to construction tech and adjacencies like manufacturing, design, logistics, and things of that sort. Having said that, that's still a lot, right? And the absolute number of companies in these sectors, I think since the time we started, has exponentially exploded. I think as more and more success stories have emerged, the number of companies have emerged as well. I must mention we have I would say a small team by VC standards. All in all, we have about 7 investment professionals, including the 3 partners, which is not a lot. I'll acknowledge that to cover the whole world, but that's what we have. And they do a fabulous job as well. Look, in terms of how we go about doing it, I think if we relied on, let's call it the traditional model of VC, which is a lot of in-person meetings, a lot of judging people based on impressions in in-person discussions and so on, this model wouldn't work. I'll be the first to acknowledge it. So what we actually rely more on is what we say is like a double pyramid sort of approach. I wish I could illustrate it over here, but our ambition is to look at as close to 100% of the companies as possible, but make sure that the very top 0.1% only want to work with us. So that's kind of the duality of how we approach it. So in other words, I guess we do the usual VC things of, you reaching out, mining social media and stuff like that. But we specifically focus on what's needed to be done to make sure for the top 0.1%, we are top of mind. So this is basically evangelizing our co-investors, the founders we already have, other important people in our network. What's also been going quite well for us over the last, I would say, year or two, is using content. And I mean, who knows it better than you? I think content is very powerful as a means to drive home what we're looking for. And we found that's actually created a very compelling value proposition where people relate. So firstly, it's a nice proxy as a substitute for a lot of in-person meetings. People get a flavor for who we are, because a lot of our podcast conversations are very unprepared. There's no real script, so we kind of just shoot off the hip all the time. So people get a flavor for what to expect if we partner with them. And what we also use that to do is broadcast specific models or themes or traits we're looking for. And every now and then we find there's a bit of resonance with what a founder might be working on or thinking on. There's a bit of a philosophical match that happens. even before the first meeting as a result. And generally we have found that also has been working quite well. I mean, I'll also acknowledge it was not easy for us the first 2-3 years. I mean, as crazy as that sounds, the first year we didn't even have a website, believe it or not. So people talk of stealth startups. We were truly a stealth VC in our first year, operating without a website. That's how actually we got started. I'd say the last couple of years or so, we have been helped by the success of some of our earlier portfolio firms, which have gone very well for us. And as you know, that also has a nice bit of network effect, quite literally, and it creates a source of unfair advantage for us. So I think we're now sort of benefiting from being in that cycle of the business.
Can we tuck into those? So you're in your third fund, you're seeing the fruits of your labor already. What have been some of the most significant exits of your portfolio to date?
I must admit, the exits we've delivered so far have been relatively small, but we are in the wait for 2 IPOs this year and 2 more IPOs, hopefully in 2026. How much we choose to exit from those IPOs, I guess we'll wait and watch depending on how the markets respond and so on and so forth. So again, just not to say that that's money not that we will not soon return to the LPs, but it's the quantum and the timing may vary a little bit depending on how the markets go.
Could you tell us about some of the largest private positions that you currently have?
Yeah. So I think the most valuable position we have right now is with a firm called Inframarket, which also, by the way, is on the verge of an IPO within a few months. That's a company we entered around late 2020 or so, done tremendously well for us. I think when we choose to exit from the IPO, it'll be a tremendous outcome for the first fund. Right? So obviously we are all looking forward to it as a source of celebration and many other things that comes along with all of these events. That's also, as I hinted at earlier in this discussion, the first round of investment that we did in Inframarket. I mean, I wish I could go into all of the details, but there's one particular transaction there which is so wild in all the circumstances around it, as well as in the upside it created immediately for us, that it is one of the 2 most memorable deals by a long shot. And
no, don't let me stop you. We're on a podcast. We need to tell people the story.
Okay, so I think I'll have to hold back on some of the details, but let me nevertheless use the opportunity to create a bit of theatrics here. Look, I first met the founder on Valentine's Day 2019, which is something we like to joke about a lot. I remember saying, hey, I'll be in Bangalore on so-and-so date, and then I'm flying back to Berlin. Are you around? He said, yeah, I'm there the same day. As I found out much later, he actually just flew in to meet me, right? And I love these kinds of traits where the founders do whatever it takes to get stuff done. I really respect that. The cruel thing is, we could have invested in that round, but I decided to pass on that round, which was the very first venture round, which obviously would have boosted our return so much more. I took the call for other reasons to pass, which with the benefit of hindsight now was a terrible mistake, right? And we got the second time there was a round happening again, it got subscribed too quickly and we couldn't get in. Now the cool thing is, and I promise you there's a happy ending to all of this. The third time a round was happening, it again seemed like the round was subscribed too quickly, but then COVID struck, right? And then I reached out to the Inframarket guys to say, hey, you know what? I know you told me there's a round that has been stitched together, but hey, COVID has happened. A lot of people are not feeling so good. By any chance, has your term sheet fallen through? If yes, I'd love to talk to you at a lower valuation. And that's where things got started for us. And one thing led to another. We got a deal where there were two tranches or 2 rounds that happened at a very similar time. One of those, because as this round was happening, we got yet another term sheet for a much more larger, higher valuation round. As we were wiring one of the investments, I'm deliberately being guarded in how much detail I reveal, but it's up to the viewers and for you to figure out what I might be saying. So for one of the components of the investment, by the time we actually wired it, it was already worth 10 times of the amount we wired, if you can fathom that. So it was already worth 10x when we wired it. Wow. So that's how crazy the deal was. But look, that aside, I don't want to give the impression that it was some wacky stock which just went randomly up. It's a phenomenal business. To give you an idea, with the exception of, I think, maybe 1 or 2 months in early COVID, the firm has always been net profitable. That is, always has a positive net income, paying tax on that net income, etc. And today operating at significant scale, like 3 billion annual revenues and significant profits. And it's a firm which operates at a scale where it's one of the largest building materials companies in India in many of the categories it's active in. There's not too many startups out there who actually managed to achieve that in a span of, in infra markets case, about 7 years or so. Not too many firms which can achieve that in these sorts of industries in construction, where it's actually legitimately one of the largest players in many different categories.
What was it doing so well that made you want to get in and actually chase the deal and swallow your pride and reach out even though you didn't know whether or not you get allocation? Because some
Mm-hmm.
founders might enjoy saying, no, you've passed on us twice. There's no
Yes.
way I'm letting you back in on this deal. But actually, there was persistence and perseverance from your end to actually say, no, I've seen enough now to completely believe in you and have the conviction. Please, can I come in?
The interesting thing, and this is something I only properly started to appreciate 2 years or so in since Fundamental, is I think in these sort of gritty real world industries like construction, manufacturing, industrials, for the most part, with the exception of stuff around robotics and new age applications, for the most part, a lot of core supply chain applications, startups, I find, can't really hide behind tech or product as a source of innovation or for being cool. And maybe this is my personal opinion speaking more strongly. And therefore, the way you actually demonstrate how well you're doing or how good the company actually is through sheer force of execution and
Yeah.
excellence in consistently delivering good numbers, consistently doing better each month than the previous month, and that compounding effect showing up. And I think in this company, more so than, at least so far, at least any other company I've come across in my career, this company is like a beacon when it comes to compounding excellence, consistency and compounding. It's I won't share the numbers now, just to be clear, but the numbers are truly phenomenal, and this consistency and what they achieve and they have kept achieving over the years, it is something where it goes beyond the vision, or the power of the business is communicated through the execution, if that makes sense. At that
Mm.
point, you don't need a visionary to fire you up through a version of what's to come. You can see that there is something very special under the hood if this is what the firm keeps producing consistently through whatever means available to it every month, or on a month, every month on month. And I think, to me, it just seemed like a firm that was destined to be a compounding machine.
So that's really interesting. How does that feed into your due diligence of founders at the pre-seed and seed level? Are you doing extra checks? What are you trying to identify to hone in on their ability to execute?
Excellent question. So we look for quite a few things. Some of the things, obviously, look, you don't always have the benefit of actual numbers, as you rightly observed and pointed out. So what we like to do is test this out in a few other ways. So our hypothesis is the way you get very good at execution is that you put your numbers and facts first and don't go into it with a salesy or a defensive mindset with the thing of, hey, I need to sell this to someone. But you have a mindset of, hey, how can I remove all bottlenecks, and areas of improvement are put first. So what you'll usually find in founders with traits, these kinds of traits, is they'll actually first point out why things may not go according to plan. And I love seeing that, because that means they actually are aware of what might go wrong. So they're working on removing possible bottlenecks. What I also find is when you tell them that, hey, what if so and so goes wrong, or have you thought about this? They're usually not brushing it aside, or even, by the way, some of this criticism may also be negatives you pointed about the founders themselves in terms of who they represent as individuals. And quite often they'll actually acknowledge it very, very directly. And again, that is something I personally love to see, because the way you become very good at execution is when you preempt the problems and don't hide behind them. once you preempt problems, you're in a problem solving mindset. And you also use your investor as a sort of partner in helping you. You use the investor as a sort of GP or a doctor, if you will, to figure out what's ailing the body and to get rid of the ailment, rather than like, hey, I'll not show anything that's wrong to the GP, right? And I think that's kind of like how I approach my partnerships. And a lot of times when the founders also reciprocate, I find that's a very nice recipe for a very harmonious relationship. Because if I'm supposed to play my role as like a quasi GP to help figure out what's going on, I can't do it with someone who pretends like everything's well and there's no need for any tests or whatnot. You know what I mean?
Stop. Are you able to give an example or two of how you've stepped in and helped a portfolio company in a time of trouble?
Look, I think the most obvious answer, which I guess most people want to hear in response to a question like this, is, hey, have you financed the company with additional monies and whatnot? The answer to that question is yes, we have done that if we like the company, right? And if they have demonstrated excellent execution before. As difficult as this may be to say, or as unpleasant as this may come across, in our opinion, being founder friendly does not mean you keep financing them round after round, regardless of how they're performing. We don't consider that being founder friendly, because we have responsibilities to ourselves, because we also invest in the fund. We also have responsibilities to our limited partners. And we also have responsibilities to the best performing portfolio companies, right? So any money you give to floundering portfolio companies, just out of a sense of continuity or not to not hurt feelings or whatever, you're depriving better companies of the same capital. So in that sense, we are, if I go to the extent of saying we could be seen as being cold and calculated, perhaps, because we do tend to adopt that approach. Now, with that said, what I will say that quite often, unfortunately, in between startups and founders and VCs, the nature of helping startups at difficult times is quite often reduced to, hey, do you fund them or not? What I find is the willingness to have very difficult conversations and be comfortable doing that, it's surprisingly rare. And that is not to say that only founders are to blame. I think VCs are to blame as well, because what I mean by that is sometimes you need to have these difficult conversations of, hey, for example, being able to tell the founder, hey, what you're doing just completely sucks. Right? And
getting ahead of it. Yeah. Giving
right.
them warning signs before it's too late rather than letting them crumble. Yeah.
Correct. So telling them it just completely sucks, for example, or their co-founder sucks, right? Or telling both founders together, hey, one of you sucks, the other doesn't, or you are not getting along, please figure it out. Or to do other things, for example, of that nature. The art of having difficult conversations in a trusted, in an environment of trust and in a manner where everyone respects the other, it is incredibly rare. Firstly, I will say, if you're a founder or if you're a VC and you have that going, you should be very grateful. It's a recipe. It's truly a recipe for greatness, right? Because once you've reached that point where as a founder and VC, you can have completely uninhibited conversations in very difficult times, you actually can go very, very far, right? And I think that you'll be surprised how many founders actually want that. But it's also, and I totally empathize, by the way, it's also something that is very hard for the founder to ask for, because the founder is putting themselves in a very vulnerable situation at that point, because they are admitting that they haven't got things figured out. And similarly, for a VC to acknowledge this is to acknowledge that, hey, I made mistakes with my thesis, and obviously with my partners and stuff, I'll have to acknowledge that things have not gone according to plan. But look, our belief at Foundamental is that is how you find great investments. You've got to get very comfortable with doing these uncomfortable conversations, including discussing what is not working well. And I really wish more VCs would take a proactive role, because the founders have more at stake here. And VCs would maybe literally get off their high horse and have these difficult conversations instead of pretending like to be these formal board member types and not. I think more founders want to have these kinds of conversations. I think what we generally do, specifically in positions that are meaningful for us, is to not hold back at all with these difficult conversations. It doesn't always go down well, I will acknowledge that, because it also takes a certain kind of personality to receive it well on the other side. But in the best of cases, it actually causes an immediate leveling up of the relationship. And for that reason, at least for me, it is well worth the initiative, because if I can get through that hurdle, I know that the firm and the partnership and the outcome, it's probably sorted. It'll take care of itself in the future.
Oh, that's really insightful and actually refreshing. So many VCs want this image or persona that they'll do anything whenever the time comes calling.
Yeah,
And then the founders are under this impression that they have this support system, when actually the reality is they might not speak to you again. Like there's plenty of examples of VCs not replying to people in their portfolio
yeah,
in times of need, especially when it comes to finance. It's the belly of the beast. As soon as you accept VC capital, you should be aware that a significant percentage of anyone's portfolio is going to fail. And it's
yeah.
your job to not be in that cohort, but it is inevitable.
You know,
So yeah, no,
the other thing perhaps I'll add to this is, I think in a discussion recently that Vinod Khosla had with someone, I forget who it was. So he mentioned that 70% of VCs add no value. Oh, sorry,
yeah,
90% of VCs add no
yeah.
value and 70% add negative value. And my hypothesis on why that is the case is, I think most VCs have a very, now this is my personal opinion, very narrow-minded definition of what value represents. And I think quite unfortunately, quite often value in their eyes comes down to either a financing decision or pretending to be like an operator, somehow, making operator decisions on behalf of the founders. So our view is that if we have invested in a company or a founder or founder team, they must be better operators of the business than we are, of the same business. And therefore, we cannot be operators of that business. That can't be the role we play, right? And literally what I find, and that doesn't mean that's the way to go about it, but literally in the best cases where clearly the problem is not operating the business, but somewhere else, sometimes I choose to just take on the role of a therapist, believe it or not, or like a coach to an individual sort of a thing. And I find that actually helps unlock some bottlenecks.
Look, I've picked your brain for a long time here. Where can founders find you? I'll include all the links in the description. But someone that's building the next generational company in construction technology or adjacent, how can they reach out to you?
So look for us on Foundamental.com. I think what we try to do is put a great deal of emphasis on our philosophy. We put out a letter to people who show up on our website to find out just what our philosophy is. And hopefully you find that resonates with your line of thinking. You'll find we also have a very unconventional profile page for each of us, which hopefully gives you an idea of what kind of people we are. You can find us on LinkedIn, on Foundamental. Each of us are available. Our emails are also available on our website, by the way. So feel free to reach out to us. We run a few podcasts as well. My partner Patrick and I, we run a podcast called Practical Nerds, where we talk about what we are looking for as companies or founder traits. So if that's something that appeals to you and you have time to spare, check us out. We'd love your comments on that.
Amazing. And look, I can personally testify the philosophy part of your website and the bio on yourself are phenomenal, very insightful. Shub, what an amazing session. You're a phenomenal investor. Thank you so much for giving us these insights into an area that I knew very little on and sharing some of those amazing stories.
Oh, it was an honor and a pleasure to be with you. I mean, I had a blast. I think this was tremendous. Thank you so much for having me over.